This is Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 5 videos on entering late in trends. Every trend after it reverses has a final trend bar. At the top of a bull trend, after you see the market reverse to a bear trend, you can spot the final bull trend bar. And the opposite is true after a bear trend reverses up. There is a final bear trend bar, and those bars are important because you have traders entering on those bars expecting trends to continue, and they get trapped, and their behavior after that affects the appearance of the chart. For example, at the top of a bull trend and the market starts to reverse, you have trapped bulls, and at the bottom of a bear trend, you have trapped bears. This is a daily chart of the euro versus the dollar. I'm always interested in what the market does when it gets new information. Here we have a bull trend bar and the market reversed. This was the final bull trend bar. Here, the market reversed only for a bar. It was potentially the final bull trend bar, but the bull trend resumed. And that's true with these other bars as well. This became the final bull trend bar before a reversal, even though we went a little bit higher. Here's a potential final bull trend bar. The leg up is so strong, we're probably going at least a little bit higher. However, here, this is that second leg up, and it's testing this high as well. If a trader bought this close and he saw this small bear bar, and especially if he saw this big reversal down, he has to take some action. He's trapped into a losing trade and he has to get out. What would you do if you bought this bull close, betting that the bull trend was going to continue up as it had been doing for the past 30 bars? And then you see this bear bar. You clearly are disappointed and you have to make a decision. Do you still think the bull trend is going to continue? Or do you think you may be buying at the top of a bull trend that is about to reverse? The opposite is true when you see the market going down. Whenever you see a big bear bar, you always have to wonder, is it the final bar of the bear trend? Here it was for a few bars. Here it was for 50 or 60 bars. If you happen to sell the close of this bear bar betting on a reversal down, what would you think once you saw a bull bar here and another bull bar here? How would you behave? And understanding how traders behave when they enter on a potential final bull trend bar or potential final bear trend bar is important. It gives you an idea of what the market will do over the next several bars. The bull trend bar here is not particularly big. It's not a particularly strong breakout. It's a second bar up after this breakout. This breakout is strong enough to have a second bar up, but not necessarily more than that. And you can see what took place on the next bar. As soon as the market went above this high, bulls took profits. That tells you that a lot of the bulls who bought that close bought it expecting a scalp, a small profit, not a big profit. And you can see also that bears sold above this high, expecting that the market would not go up very high and that it would go down far enough for them to make a scalp. The bears see the bad follow through after this bull bar. There's a big bear bar here, and there are 3 bull bars, but the bodies are shrinking. And the bulls see that, and they know the bulls are not buying aggressively, and therefore this is probably no longer a bull trend. Maybe it's a bull leg in what will become a trading range. And maybe it's the start of a reversal down. What took place here? It's a give-up bar. The market went up here and went down here. The bulls who bought this close, or for any reason, were sufficiently disappointed by this big bear bar and by the shrinking bodies on the bull bars and the tails on the tops of these bars that the bulls decided that rather than going up, the market might be entering a trading range, or in fact, it might reverse into a bear trend. In either case, they don't want to be long at the top of a bear trend, and they don't want to be long at the top of a trading range. And therefore, the bulls gave up. They sold out of their longs. The bears understand what's going on. They know that the bulls are selling and only willing to buy after a couple legs down. The bears sell as well. You have both bulls and bears selling on this reversal down. The market's been selling off certainly from here, more or less from here, but anyway, a lot of bars. And we have a big bear trend bar. The bears are trying to get resumption down, a fairly tight channel, but we're near a prior major low, which is a potential support area. Some bears will sell, taking a chance that we break below this low and that low. However, had you sold that close, and then you see a small bear bar, and then a bull bar, and then you're starting to see tails on the bottoms of bars, what are you going to do? You can see that had you sold that close, bears are not selling aggressively. In fact, they're probably buying. We're getting tails below, we're getting bull bars, potentially a double bottom here, potentially a bigger double bottom here. So instead of bears selling for a swing down, bears are scalping out or trying to get out break even. And bulls are deciding that this is a good price for them to buy. And what happened here? Well, we got a bull bar and a follow-through bar. We went down and we are reversing up. It's a 2-bar reversal, down and up, even though the second bar took place 6 bars later. This represents bears giving up. The bears who sold are disappointed by the follow-through, and they're deciding that maybe the market's going higher, and therefore, let's get out and look to sell again higher. I want to talk a little bit about trapped bulls. This is a 5-minute chart of the euro versus the dollar. And traders are buying closes. They're buying for any reason, and they're certainly buying closes. The bulls hoped that this breakout would continue, but they knew they were buying at resistance at a prior high, and therefore there was a risk that instead of continuing up, the market might instead go sideways in a trading range. Unlikely to become a bear trend. When a bull trend is this tight, usually the first reversal down is minor, which means it probably will have to go up and form at least a double top before it can go down very far. Whenever you have the biggest breakout occurring 20 or more bars into a bull trend, it's more likely an exhaustive end of the trend than the beginning of an even stronger leg up. They know they're buying when the market will probably go sideways, but they're confident that any pullback will be small and they'll be able to get out break even and avoid a loss at worst. And possibly it might go far enough up for them to make a pretty good profit before it pulls back. Some bulls who bought this close buy more 10 pips lower, knowing that the first reversal down will be minor, and the best the bears probably will get over the next several bars is a trading range. They buy hoping it goes straight up, knowing, however, that if it goes down, it will not go down far. They bought this close. They buy more with a limit order 10 pips lower, stop down here or down here. And they're sufficiently disappointed by the size of these two big bear bars, a lot of the bulls decide, I'm just going to get out break even at my first entry and take a 10 pip scalp on my second entry. Some bulls might hold and then exit on the test of the high. Another 5-minute chart, euro versus the dollar. Strong breakout, bull bars closing near their highs, big bull bar closing far above the high of the past 30 or 40 bars. And then the next bar has a bull body as well. The market's probably going up for at least a measured move and at least a second leg. And therefore bulls buy for any reason. One common reason to buy is a bull close. So they buy closes. Most traders do not buy every close. Some buy one and then scalp out for 10 pips and then buy again. Others buy and then add once or twice to their position, scaling into a winning trade. They buy expecting a quick profit, but they are also aware that the market can reverse at any time. However, when it's up this strongly, the first reversal down will probably be minor and become either a bull flag or a bear leg in a trading range, and in either case, the market will go higher. The odds are that after any pullback, it'll get back to their entry price and probably go higher, and therefore they're willing to buy at the top of the market. Let's say you're a bull and you bought for any reason and you're buying right here. Let's say you happen to buy this close, hoping that the market would continue up. You're hoping for an immediate profit, but you're confident that if we get a reversal, the best the bears would probably get is a trading range and the market would come back to your entry and you could get out break even. And if you're lucky, you could buy more lower. And then when it got back to your entry price, you'd get out break even on your first entry and then with a profit on your second. Sometimes the bears win and it just goes straight down, but more likely, maybe 70%, 80% chance, the best the bears will get is a trading range. After they have a trading range, then they can get a major trend reversal. For example, here, a lower high major trend reversal. But over the next 10 or 20 bars, the best the bears will probably get is a trading range, which means a leg down, followed by a leg back up to your original entry price. For example, a bull who bought here hoping it would go straight up would not be upset by this. He'd be disappointed, and he'd probably conclude that instead of a bull trend, the market is now in a trading range. But he could buy more above a bull bar here, as long as the second entry is at least as big as a scalp. And when you're trading Forex markets, the minimum scalp is 10 pips. If he sees a bull bar reversing up and his entry is at least 10 pips below here, it's a reasonable buy, especially since it's about a 50% pullback from this breakout and a breakout test of this high. It's a good buy, betting that it will at least get back here and he could get out break even on his first entry and then with a 10 pip scalp on his second entry. And that's what took place here. This rally had to go at least 1 pip above his first entry for him to get out with a limit order, which it did. And you can see what happened as soon as it did. It reversed down. That tells you that a lot of the bulls who bought this close were disappointed by the sell-off and they were selling out break even. It also tells you that bears knew the bulls would do that, and the bears sold there as well. Bears will sell either with a limit order exactly where the bulls are taking profits, or they'll sell on the reversal down for the lower high major trend reversal. Here's the highest close of the day. The bulls tried to go higher here and they failed. Tried to go higher here, they failed. Tried to go higher here, again, they're failing. When the market tries to do something 2 or 3 times and is unable to do it, it then usually tries to do the opposite, which means sell off. And we got a broad bear channel. I talked about trapped bulls. Let me talk a little bit about trapped bears now. Again, the euro versus the dollar, a 5-minute chart. The market tried to reverse up and instead reversed down very strongly. And some traders were selling for any reason, including selling closes. Some traders would have sold this close, hoping that it would go down immediately to make a profit, knowing that when the sell-off is as tight as this channel is, the first reversal up would be minor, which means the market would probably have to test back down here. and they could avoid a loss if they managed their trade correctly. Therefore, they were willing to sell, knowing that the worst that would happen is they get out break even, and the best that could happen is it could fall quickly and they'd make a quick, big profit. There's a problem here. They knew they were selling at support. You could draw a trend line across these lows, and the market reversed up there, pulled back, and maybe it'll reverse up again, which it did. They know they might be selling at the end of the bear trend, but they also know that this bear channel is so tight, the first reversal up probably will be minor and lead to a trading range and not a bull trend. The bears could place a limit order to sell more 10 pips higher, the size of a minimum scalp, confident that the market would probably not go much higher before it tested back down to the low close. A lot of these bears are so disappointed by the sharpness of this reversal that instead of trying to get out with a profit on their second entry, they're going to use their second entry simply to avoid a loss. They entered here, they sold more here. Their average price is right in between. And in hindsight, it's clear that a lot of the bears got out break even on the trade rather than down at the low close. You can see it got to within 2 pips of the low close. It had to get 1 pip below that low close for these bears to get out break even and for them to get out with a 10 pip profit on their second entry. And what happened when it got near their target? It reversed up quickly. And part of the reason why it reversed up quickly is the bears knew it might not get there. And if it did not get there and started to reverse up, a lot of the bears would just start buying back their shorts at the market, trying to avoid a loss or trying to reduce their loss. Yes, they sold here. As it got to within a couple of pips of their target and started to go up, a lot of the bears started to buy back shorts, and they had a loss here, maybe 6 pips, 7 pips, and maybe made 3 pips profit here. This reduced their loss, but it did not prevent their loss. This is the bears panicking after being unable to get down to that low close. And now they're simply trying to get out break even on their trade at the midpoint between their 2 short entries here. The bulls see the market reversing up quickly. They know the bears are trapped and they have to get out to minimize their loss. And therefore the bulls buy. They buy as the bar is forming or with a stop above the high of that bar, even though it has a bear body. They see that it got to within a couple pips of the target for the bears and is reversing up. They're betting that the bears will panic and have to buy back their shorts. And this is a give up bar. The bears are finally giving up. And therefore, we're probably going at least a little bit higher. Maybe a measured move up from this double bottom. Here's the double bottom. Here's the neckline, measured move up right here. I began by talking about final trend bars. Once a trend reverses, you can look back and find the final bull trend bar in a bull trend or the final bear trend bar in a bear trend. And you know that there are traders entering in the direction of the trend on the closes of strong bars. That final bar means that the trend traders are trapped. They'll take those trades as long as they know how to manage their trades. So for example, in a strong bull trend, a trader who bought the close of that final bull trend bar knows that the first reversal down will be minor. He can scale in lower, expecting the market to get back to that final close that he bought, hoping instead of reversing temporarily into a bull flag, the market just keeps going his way. And the same is true in a bear trend. You sell bear closes hoping the market immediately goes your way, but confident that you're selling in a strong bear trend. If it reverses, the reversal will be minor and not get very far. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on entering late in trends.